The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly.
Słychać w
Please
ogóle tego?
remain on the line.
Włączył mikrofon w ogóle. Nie wiem, czy robić jakieś powitania. Chyba nie, to są nagrania, te, które w oryginale mają być, to nie będą w oryginale. Wyłączę Majka w YouTube. Pozdrawiam wszystkich. Tak, program stworzony dzięki członkom
The
grupy
broadcast is now
rozpoznawczo-operacyjnej
starting. All
M1. Tak.
attendees are in
Pozdrawiamy
listen-only mode.
wszystkich. Jak
Hello again,
najbardziej.
everybody. Thank you for joining us
Axarox,
for
Andrzej,
the
tak, Dandy,
webinar this
Dymek,
afternoon,
Hakinen, Jarek,
FOMC Minutes
Kozłowski,
and
tak,
the Homework
Chris,
Workshop
Lukas,
Part
Marek,
1.
Marian, Tomasz, Opek,
Obviously,
Robi,
FOMC
Robku,
Minutes
pozdro,
isn't for
Siemakos,
about another
Tomi,
57
Wałek,
minutes,
Szuren,
so we'll be
jest
going
moc.
over market stuff as well as a presentation. Any questions before
Pytania co do
the FOMC
prezentacji,
Minutes?
co tu w ogóle robimy przed
Hello
FOMC?
again, Jim.
Robimy
We're
minutki
starting with,
FOMC
I have
oraz
a
zadanie
question
domowe.
for all of you. Look at H period is selling off a little bit. Who knows why
Wyprzedający
H
się
period
okres
is
H.
selling
Dlaczego
off?
okres H się wyprzedaje? Kto wie? Kto wie, dlaczego okres H się wyprzedaje?
I'll let you know when folks participate and type some things in. We still got people coming in.
The question is, who knows why H period is selling off?
Kto wie, dlaczego okres H się wyprzedaje?
Okay, it didn't take out one-time framing, 10-year bond action, 10-year dropping, because there's acceptance below 43.89.
No, the 10-year bond auction, and I don't have no idea of the results, but I can see that the prices are dropping on the bonds and the yield is, is rising. So I can take a guess from that the 10-year auction, was another sloppy auction or not really good. And remember, I put out on the live commentary today,
Wrzucił w komentarzach na żywo,
remember
mówi.
yesterday, the three-year, didn't go so well, and it is what triggered the sell-off yesterday afternoon. So we should be watching for the 10-year today, and the 10-year auction happens at 1 o'clock, and that's exactly when this. I think what happened, you got short-term traders, they bid it up a little bit ahead of the auction because they didn't want to be short coming into the auction. As soon as the auction results came up, then you got then the H period started to sell. Now, some people may say, well, I don't see anything about of that in any of the lessons you teach or anything else. And if you're going to be a trader and you're going to compete, it takes a lot of time.
Traderami, tak, mam
but you have to be aware of, I'm not aware of everything, but I'm just aware of just certain things. And I pointed it out this morning on the live commentary. I don't know how many people saw it. And just to be aware, if you're a short-term trader, be aware that you may get some volatility at 1 o'clock. If the auction was, as nice, good as planned, then probably, nothing to go on. But I look now and I see the bonds have dropped. So I'm going to guess that if I read the news, it would tell me that it was another sloppy auction. But again, those are they're just pieces. And a lot of times people want to be successful trading and they want to do it mechanically. They don't want to understand those things. They just want to do it, by the numbers. And remember that the failure rate is just huge. Most people, they don't know. Nobody showed it to them. And it's little tiny things that you accumulate over a long period of time. Okay. Any questions before I go to the next item?
Before you what?
Go to the next item.
Oh, okay. Yes, there are some questions. Okay, how long do these auctions go on?
That's why we showed you yesterday where to get the schedule. And, it's wherever the government auctions go. You just look at the schedule and the auction itself takes place. The announcement like this at 1 o'clock Eastern time. So the auction can be underway, but the results of the auction, it's when the results of the auction are released, and the results of the auctions are released at 1 o'clock Eastern. Okay, what else we got?
Okay. Except in D period, the market has been selling off all day. Can we assume that the H period is selling off because of bonds? I ask this because it didn't start selling off this period.
Well, yeah, like I said, my guess is that short-term traders, they bid the market back up just to cover their shorts in G period, because they didn't want to be short when the bond auction came. And then the auction came and it wasn't very good, and then the market sold off. I mean, it's nothing dramatic, but I'm pretty sure that's what it was.
Okay. Okay, I think we got to our questions for now. Do you want to continue on?
Yes. Okay. I also put out on the commentary this morning that, and this goes back in, it's the homework, rolls into the opening in the morning. But what I put out there is one of the very first things I do, and if you read the live commentary, and I said now it's just I've done it so often, it's automatic now. It's like backing the car out of the garage, you just get in and go. But this idea of how much confidence is there in the market in the morning, and that how much confidence there is in the market has an awful lot to do with the decisions I make trading wise. So this morning, the confidence was very low this morning, right? It's within the previous day's range. Confidence is very low. Okay, now that helps me make decisions on how I'm going to execute trades. For example, I gave you another example on the live commentary where I had bought I think it was 343.90. I think it was 343.90 puts this morning as a speculation, as part of the hedge on my hold position. When the market sold off in E period, when it got down, when it was selling off, and before it got to the overnight low, I just hit market to sell the 43.85s. Now, the point I was trying to make in there was the decisiveness. You can sometimes we get down there and say, oh, well, I don't know if I want to sell it here. Let me see if it goes any lower. And then all of a sudden it goes back against you. I'm sitting there saying, okay, confidence is low. Confidence is low. It could easily go straight on or go back up. Confidence is low. The minute it started down to that area, I just hit market and sold. Okay? It's that decisiveness, but so much was set up based upon early morning confidence. Had early morning confidence been high, as the market was selling off, now as it came down to a reference, I might give it a little more tolerance to see, what there is, if there's any more follow through. But I wanted to show you that because these are nuances. And remember, the difference so many times between profit and loss, success or failure in anything is pretty slim. How you make decisions, your decisiveness, do you overthink things, is really relevant. Okay, I'll take questions on what I'm just talking about because I think it's very important.
No questions just yet.
Okay, comments on it, agreements, disagreements. Is this, does that help you, kind of in your mind? What I'm trying to do is, working this mindset, how, when you make trades, how are you going to do them? Sometimes, sometimes we overthink them. Sometimes we just do them. Anybody commenting? Anybody adding to, subtracting from?
Nope, I don't see any comments right now.
Okay. I don't know if I put anything else out there this morning or not, in there. Oh yeah,
You
there's
want
one
me to
other.
show the comments? I can bring them up and then you can, that
No,
way you
I
don't
think
miss.
I think those are the important ones. The other thing now, people have asked about the strangle several times, but I don't know if you remember that I believe the original puts were when they 42.90s, I think. And if you remember the other day, I said I rolled the 43.90s up to the 43.30s. That's and I think it was 6 ticks or something. It wasn't a lot of ticks. So, but now it's in. I haven't done anything, but now, remember they don't go till Friday. This is Wednesday, so we've got the rest of Wednesday and Thursday and Friday. So 43.30 is back within striking distance. So 43.30 is back within striking distance. So they could increase in value very quickly. Or, if it really breaks, it might give me a chance to sell the, a lower strike price against to bring in cash. I'm only going through that for those that have an interest in, how these things work. A lot of times, people think of it simplistically. Well, where are you now? And they think about where'd you buy it, where'd you sell it, where's it at? And of course, I do, trading against it. So there's no nice, neat tracking answer against it. But rolling up the 42.90s to the 4300s puts in strike. If the market really breaks in the next couple of days or something, that puts those back in play, and that could add to the profitability. Okay, I'm just giving you an idea that it's not static. It is very rare that I do anything that is just static. Okay, questions?
Yes, okay. When you say confidence is low, that is both to the down and the upside, correct? As that's applicable.
Yes.
Okay. Somebody's asking, what gives confidence?
There's no answer to that question. You're just looking to see what goes on. When you look at the market, when you look at it every day, this is where experience comes in. Some days you'll see remember yesterday, the market had high confidence. Well, there's no answer what gives it confidence. There's so many different factors involved. It may be short covering. It may be long liquidation. It may be new money buying. It may just be that, that the momentum traders are excited. There's no neat answers to those questions. And if you start looking for that, you'll probably drive yourself nuts. But as a trader, as a short-term trader, you learn to look at the market and just assess, is the confidence high or low? And it's something that I can't give you a definition of high confidence, low confidence. You gain it with experience. Well, first of all, if you open within the previous day's range, okay, as open within the previous day's range, well, guess what? There's not the odds of having any significant confidence are greatly reduced because you're within the previous day's range. You're not out of balance at all. Okay, anything else?
Okay. Does the fact that the market couldn't test prior day's highs make you more bearish?
Not particularly. I mean, remember, I don't like the high or the underlying structure is terrible. But remember, 165 handle rally, there is no excess on the high nor the low. And I don't like the term bearish or bullish. And the reason I don't like, and I'm not coming at you, I'm just saying the reason I don't like those terms is they tend to give us a different mindset. Oh, it's bullish. Oh, it's bearish. And that's kind of like, either fast or slow. I like to think in the term, and you don't hear me use that term very often. I like to think in terms of how much confidence is there. It's easier, I can confidence I can think of in terms of gradients, confidence high, low, etc. Bullish or bearish, you don't say, well, it's slightly bullish, slightly bearish. They're almost absolutes. So but go back to I know the base of your question. I certainly recorded that we couldn't take that this morning, but I'm also recording how slow it is on the downside, and I know how fickle this market is. You've got the momentum. You've got the momentum traders that are long. I don't know if we're going to break their back or not. Like I say, it's a total terrible underlying structure. But I never thought it would do what it's done in here. So I'm careful. It's certainly not positive in there. But the main thing I was focused on more than anything else this morning was the confidence. Okay. What else we got?
Okay. What about the 43.89 level? Jim had mentioned that if there was acceptance below, it would bring yesterday's low into play. So why did Jim come out of his short?
The market this morning, the confidence is low. And I didn't come out of my short. I sold against it. I sold against the short. So it extends it. But part of that was, I'm not focusing on particular straight dollars. I'm focusing on, at the time, you were coming right down and the confidence was slow. And I said, okay, it's the options expire today. It adds to it. It actually, I didn't know at the time, but it actually put it in a no lose situation because I got more for the ones I sold than the ones I bought. It's just a very practical short-term trading decision. Okay.
Okay. I'll just, the next question is one that we have gotten before, and I know that this is this person's first intensive. Okay, Jim? Okay. When doing your recap reports, could you include all your trades and your rationale for each trade? From the comments, most in here are not familiar with options presently. If these trades were included with the rationale in the daily recap when reviewing the course in the future, this would be very educational and give great educational value.
No, that comes up all the time. That comes up all the time, and it's just not something that understand that people tend to think that every trade is a nice rational trade. Remember, we spend so much time talking about intuition, and sometimes you do trades just because they should be done. And it's like I talk about the batter that hits the home run. Well, they can't go out and you ask them to explain what happened, and they can't give you a full rundown on it. because as you get experience, there's so many things going on in your mind in there. I mean, it's, some trades are going to be related to your position, that you're just lightening up your position out of prudence. Some are because, it's clearly market oriented. So I understand the question, but I've never answered those questions. And I'm not sure. I try and do it from time to time if I think there's educational value in it. But every person is different. And people aren't going to trade the same way I do. They don't have the same experience. They don't have the same, financial background. And so I'm not sure that's beneficial. Okay. I mean, I understand the question that comes up quite often.
Yeah, I totally understand from a newer person or less familiar person's aspect why they would ask this question. I'll just also add that as you've seen, because Jim has had this strangle and done all sorts of different things against it, and we're talking like it's been a few days, right? So it gets complicated. There's just no way to follow everything and to be able to write that all down and get people to understand the thinking for every. That's why he's sharing day by day, some of the things he's done or why he did some of those things, or to also demonstrate the level of creative thinking that went into some of these parts of these trades. So that's the knowledge, some of the knowledge imparted with regards to actual trades. He is sharing that information for the educational purpose of that, and to demonstrate, like I said, the creativeness, and also some of his reasons for why he did the strangle. Because I can tell you from all the intensives and observing Jim, he does not do strangles all that often. It's not something like, I know we had a question in the last webinar or something like that about, does Jim try to do these strangles every week? No, it's this market environment and the conditions that he sees that, okay, I'm going to employ the strategy of using a strangle here.
And I have been on record. I'm sorry, Jen, to interrupt that, but I've been on record as saying the buying of strangles and straddles is probably the worst strategy available. And I do believe that overall. But there are, from time to time, different kinds of volatility, different pricing, that all of a sudden you say, okay, that makes sense because of the certain market conditions. But I've said several times that they're terrible strategies overall. But recently, as I've said, what has got my interest recently is I thought that the options were undervalued based on the daytime frame volatility. The way they price these things, the VIX is based on put buying. When the institutions are out there heavily buying puts in order to protect positions, the volatility may not be that high, but it can make the VIX go way up. Well, late last year, there was a huge short covering rally, and it doesn't appear that there's many institutions that have bought puts to protect their positions. So without a lot of buying, the VIX, which is based on put buying, is cheap in my opinion for what I see in the market. But in most of the cases, I'll say it's a terrible strategy. And it still might be a terrible strategy for most, because it takes some creativity to make these things to work. I mean, I use it because I trade against them. I don't buy them and just look for one direction. If I'm buying long the calls and in the market, well, you saw the other day, if I remember, I was long the 43.30s, I think. And if I remember right, the market ran up very quickly to 43.60 or something, and then I sold the 43.90s or something. I don't remember the exact thing, but against it, taking in cash. And one of the best ways to ever protect a position is by cash. Now, you can overdo that, but it's that kind of thinking that's going on. And I'm looking, and I want it in a volatile situation because to give you a chance to go back and forth. Okay. And then there are times I may do some, little dinky trades against it because I'm watching it, and I may do some little short-term trades against it, as you saw the other day. I mean, it's just creates what it does for me right now because of the pricing. It takes a little bit of the need to be exact in the market. Okay, what else have we got?
I just wanted to add to that because I understand where this person's coming from because I used to be that person and think, logically, hey, why not just ask Jim, or Jim, why don't you just share this and explain, all the details of this and that. And so after all my years of observing you and hearing you tell that to a bunch of people and myself, observing that, et cetera, this is kind of what I've come to conclusion to. And it's just as we say, every trader has different personality traits, tendencies, bad habits, all sorts of things. And it's natural to, like if you're not an options trader and you don't understand that much about it, or you're wanting to learn, or maybe if you are or you have traded options, then hearing Jim, because if you understand some of the basics of how options work, then hearing Jim say, hey, I'm very different from everybody. I don't use the Greeks and I don't do this and I don't do that. I'm looking, here's how I'm looking and how I'm approaching it. That gives you creative thought ideas that maybe you hadn't considered before if you're an options trader. And if you're somebody who's not an options trader, at least then you get the idea of Jim explaining about some of the reasons for what he's doing and his tactics but what you're really getting out of the intensive is how to observe the market, understanding the odds and probabilities and how he's taking all of those things into account given the situation, understanding what things are repetitive that he will definitely look at, seeing how he makes adjustments each day, the variation for situations. And because we can't, it's impossible to just trade exactly like another person per se 100%. So I think what you take away from this, especially if you're newer, you're still trying to discover yourself or get more self-awareness for whatever parts you need, that you need to work on for yourself. And I think every trader has that. You're learning these things, and it gives you ideas so that later on, as you have more experience or you're exploring, you're like, oh, now I kind of understand why Jim says that. Or maybe you'll find, now I really understand why Jim says trading options makes him less emotional, kind of takes the edge off from just having to be right in a direction, picking a direction and being correct. Things like that. That's just my perspective, how I'm kind of summarizing up. But I really sympathize, when you're a trader, you come in, you're learning, and you hear Jim talking about these trades, and, it's frustrating because you want to understand, you want to know all the different aspects, what happened in the market that made him think this, or do this, or do that, or adjust this, or adjust that. Okay. I hope
remember,
that wasn't just long-winded and useless, but
everything's based upon market-generated information. So it's not it's based on market-generated information. It's based on my own personality in there, but it starts with the market-generated information. For example, I did not like yesterday's low. I've said this market is very stretched out. Didn't like yesterday's low. And then this morning, when the market didn't have a lot of confidence this morning, I said, there could put some pressure on some of there's going to be a lot of weak longs in there, a lot of weak momentum longs. So that kind of influenced how I would, go this morning. And that kind of influenced why I bought the 3 puts, just because I thought that there, could be a little liquidation as time went on. But I didn't, the day before a big number, it's very often not a disaster. So it was just a kind of thinking there. Now, then I added, and these are the kind of things that they're really hard to quantify. But as I said this morning, that I don't read, and I advise people, I don't read the economic releases. I want to know when they're coming. However, I also say I don't live in a vacuum. I can see when those economic releases come, I can see the way the market trades. So I have a pretty good idea of what the release was. This morning, when PPI, remember, PPI comes out on Wednesday, CPI, which is the bigger number, comes out on Thursday. Now, when PPI came out this morning, the bonds sold off, and then they came back up, but initially they sold off. I said, okay, now an awful lot of people have gotten long in here in this market. And if you remember some of the things that I think I said it in the weekend report, or I said it out loud the other day, is that the world out there is talking about a positive number of 0.3 on CPI tomorrow. And that's a wonderful number for it. But I heard them on overseas. I heard them talking about this. I heard them talking on CNN. Everybody's complacent. Well, now this morning, when PPI was a little out of line against the expectations, then I said, okay, you know what? This may shake up some of the longs that aren't as comfortable and not as assured of themselves now that CPI is going to be this wonderful number they thought it was and supportive of the jobs report. So I said, I wouldn't be surprised if the market's not a little softer and maybe a little bit of liquidation of people that, square up their positions a little bit prior to the big number tomorrow. Now, somebody can say, well, Jim, that's not part of, market generated information of this reference. That is part of trading. I don't live in a vacuum. I don't trade in a vacuum, but I don't obsess over those things. I just use a little bit of common sense and just think about it. Look how far this market's come. Last night's report, 165 handles to the upside from last Friday's low. I mean, that is just a huge rally. And so much, and then they've been talking so much about this CPI number tomorrow. Well, if something puts a little doubt of hesitation in them, there may be some people that lose confidence and, liquidate a little bit. Anyhow, but that is part of trading. That is part of trading. And remember, I said, so many traders come in the market and what they know is they know half back, they know the high and the low, they know the settle, maybe the last price. And those are where they make their decisions. That's where a lot of these references come from. So their in-depth isn't very good, and they're doing what everybody else has done. And if the majority of people lose money and you do what everybody else does, guess what? You're probably going to have similar results. Okay, I went blah, blah, blah. Questions, arguments, challenges.
Yes. Okay. Momentum traders seem to be long, but today most highs are weak. Is this just a sign of lack of confidence or that momentum traders might be getting pressured?
There was an awful lot of long inventory in here, and there's just not enough underlying buying to take it higher. There's some mechanical buying on every little dip, from early on, and now they're, as you get later in the day, there's less confidence. But yeah, the problem with momentum trading, this is, and this is a little off the question, but momentum trading is by far the most prominent type of trading there is. Why? Because it's simple. Now they've come up with, all kind of indicators based on price, but price is an advertising mechanism. Okay.
Incoming mail.
But they've tried to give structure to price. And I'm reading this one book, and this guy's talking about, some rather sophisticated things. And then all of a sudden he comes out, he says, but price is everything. And it's just simply not, it's an advertising mechanism. If price is everything, you go to whatever the dealer price the dealer's got on the car, pay it, because that's everything. Well, that's not the case. And so, but momentum, if you don't respect momentum, you're going to get run over, because that's what the majority of people do, including a lot of the institutions. You know, as I said, they came out of the woodwork in June. We had this big rally in June. You had some really top technicians out there talking about new highs by the end of the year. And the market went up a lot because they followed for a while. And then the market took all of that back. And that's what happens sometimes. I mean, they're basing it all on price. I mean, just ask yourself, if you're trading based on price, you say, well, everybody else is doing it. Not everybody. There are a lot to do it, but not everybody. And if you really are doing that and you think price is everything, don't ever bargain. Don't ever bargain. Whatever the price of the car is, that's what you pay. Okay, what else?
Okay, so circling back around to what we were talking about earlier, because somebody requested about sharing your trades and the rationale behind them and writing that all out. We've got some comments with regards to that. So to be honest, I like Jim's approach of not showing all trades. I think if he did, I would just feel pressured to have to trade the same way. I really like his approach of selecting only the trades or strategies that he finds educational and keeps the focus on market generated information. And another comment.
Let me say one thing before you go on. We have had a number of professional traders that have been clients, and their reason for being clients is that they don't call trades because they don't want that. You talk to a professional trader, they don't want to hear what my trades are. They want to understand the market and market generated information. If they could add that to it, that's something. But I just add that. Okay, Jen, I rudely interrupted you again.
Oh, you do it all the time.
I know.
Okay. Another person said, I agree. My trading is 80% intuition and 20% technical analysis. It's impossible to share a trade with another trader as they will not understand it. 20 traders will look at the same chart and each will have a different view or idea. That's right. Because like I said, we're not all duplicates of each other.
different time frames, different risk tolerances, different trading money.
Okay. Let's see. Okay. I'm still struggling with allowing winners to run. I went short in the G period at the G period POC, and I took profit in H period. What chunks could I have taken in to let it run further?
I can't answer that question.
I mean, this is slow, right? I mean,
yeah.
The only thing you have going for you right now is that it's, we're one time framing lower since the.
Well, I mean, look at me. I had the puts, and then I sold puts against it, which is basically, it gives me a little extension to the downside, but it kind of stops the trade from that aspect because the confidence was low. But I come back and tell you, if you get out of trades early, I'm not sure that was wrong coming out of that trade early this morning, just because the market's going down. Just because it went lower doesn't mean your decision was a bad decision. But do remember, if you got that habit of coming out of trades too early, what we've said, it's a habit. It's a habit you form. And once you form habits, they take a hold of you. Believe me, I know. We got the 2 books. Read about habits, read about what causes habits. What is the trigger? You really want to get to the heart. What is the trigger that causes it? Just think, when you take a profit, because I can relate to this, when you take a profit, how good you feel the moment you take the profit, and how terrible you feel about 5 minutes later when you shouldn't have taken the profit. It's like a windshield wiper, high, low, high, low, high, low. And that's why you've got to make your decisions, and you got to learn to make your decisions, make them on a rational basis. Then you're done. You never look back. I have developed some years back, I don't know, maybe about 10 years ago, an absolute tremendous ability. And don't ask me how. People will ask me how, I don't know. But all of a sudden, I quit looking back on a trade. Once a trade is over, it's over. It's over in my mind. That's all. And I go on. And it may have come from reading Phil Jackson's book, who was the coach of the Bulls in their heyday. But it's something you hear in athletics all the time. You can't play the last play. You got to play the play right now. You can't play tomorrow's play. You can't play the last play. You're playing what's in front of you right now. And I used to have an educational tape set called Operating in the Present Tense. And then all of a sudden I got all these books that Phil Jackson had written, and it was basically the same thing. That's how the Bulls were winners, because they operated and they played in the present tense. Okay. So now we have what? We have 15 minutes until the FOMC release.
Yeah, less than 18 minutes. And let's see. Okay, here's another comment. I'm in the same trade, I believe, as the other person, and I've taken some profit rather than all of it, basically, so they still have some on. And this is how I try to gradually hold longer, but I'm not sure if Jim would agree with this idea.
I do it. The thing I don't do is keep a runner. Some people just keep a runner just in case it really goes. And I don't like that, because so many times it's an emotional decision, because how would I feel if this thing really went going? But to take a trade off and say, okay, if I start, let's just, this doesn't happen this way, but let's say I start with a trade and I've got 100% chance of being profitable. Well, now the trade's working in my direction. Well, the risk reward is going to change. It's no longer going to be 100% anymore. So maybe it goes down. Well, when all of a sudden you take some off, you're just being very rational. You're just booking some of it, because you really don't know, you're unsure, and you're just being prudent about managing the trade. Now that's different than keeping a runner. But I do it all the time. When I am, for example, if I buy the 43.30 calls and the market goes up, and the 60s, and I sell the 90s against it. That's like taking some off the table, right? Didn't close the whole position, but that's taking some off. That's taking some risk off the table. I think of it as a term, as the thermostat on your. I used to use another word, and people don't know what it means anymore. I used to use the word rheostat, but I guess nobody knows that term. But it's like your temperature. You turn the temperature up and down, for your cooling and heating and cooling. And to me, that's what you're adjusting because the risk reward is changing, and the risk reward, it may still be in your favor, but it may not be as much. So to me, it's very logical to take some off. Now there's other times when I just say, wow, it's run its course. It happened very quickly. I'm out. Goodbye. Okay, what else?
Okay. I'm always cautious the day before CPI, because 2 or 3 times during the intensives, the day before CPI, the market seemed dead. And then all of a sudden it goes crazy. I assume either because of information leak or repositioning ahead of CPI.
Yeah. I doubt if it's information leak. I mean, I won't say that doesn't happen, but I doubt if it's an information leak. But there are always people making assessments in the risk reward into it, and they just decide they don't want to have a position going in. Understand the way these institutions, a lot of times we look at, as retail traders, we're looking at one number to make this decision. These institutions, they pay literally billions of dollars to look at other numbers. So they have decisions. Sometimes they're right, sometimes they're wrong. But, sometimes you'll get them even up positions that they don't want to be that long. or that short coming into the number. But the jobs report last Friday, I think they almost all got it wrong, in there. Everybody got it wrong. And so, and markets, that's one of the treacherous things about markets. It's good if you've got mental flexibility. The volatility in the markets can be very, very positive. But if you get biases and you get hung up and you don't have the mental flexibility, it can be a disaster. Because one day you're right, you feel like you're at the top of the world, and the next time you do the same thing and you're wrong, and you can't feel any lower. All right, so we've got a few minutes. Shall we go over the homework?
Yeah, I would think so. We do have a question here that somebody's asking.
Okay.
The term runner is unfamiliar to me. Could I trouble you to elaborate?
Sure. You're long three futures. The market's going up in your favor. You think that's the end of it, or it's a pretty good time. You sell two of them and you keep one as a runner, just in case the market keeps running. That could be up or down. There's nothing other than that to it. It's just a psychological thing people do, and it's does it keep running in the direction that the initial trade was? Okay?
Right. It's just like the person who said that, they took the same trade that another person said that they already took off. How can they, get themselves to train themselves to hold it for longer or to be able to hold out more? And this other person said, yeah, I took that same trade and I'm still in it. And I've got, basically they have a runner that they're holding on to here. To try to get
everybody's a little different. The main thing is what you're doing and you're comfortable, but it makes sense. You want to continue question yourself of what you're doing makes sense.
Right.
Okay, now we can go do the homework, or we can watch this market through the we can watch this market through the release of the FOMC. We owe you some time. So we can do whatever you want. I mean, I'm not I'm not up against anything. Jen, are you?
Okay. No, not today. Somebody mentioned the slow tempo seems to feel like it's a slow boil for the shorts into the FOMC minutes. Any comments on that?
Yeah, it is. It's unbelievably slow today. I mean, it's just, but I'm guessing that what you're seeing is liquidation rather than a combination of liquidation and new money selling. People, a little pressure, the market's going down. There's been a lot of long. Remember, we've got 165 handles. There's a lot of longs, and it drips on them. The more price doesn't go higher, drip, 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 the more pressure they feel, and then they get nervous, and then they sell them. And there's a tremendous amount of uncertainty. But also, if you look at the bonds, I'm looking at the 10-year. So somebody look at the internet and tell me what it says about the 10-year auction. Somebody share that with us. Anyone?
I'll let you know when somebody types something in.
Okay.
Or do you want me to take screen so you can go and take a look?
No, ask RJ. Maybe is RJ there? Just see if there's something about the 10-year. Well,
let me look.
Oh, hold on. Somebody typed something in here. The yield on the U.S. 10-year Treasury held this week's losses under the 4.6 level on Wednesday, retreating from the 16-year high of 4.88% hit in the prior week as markets continued to assess the latest data and await the release of the FOMC minutes later in the day.
did anybody use the term it was a sloppy auction or disappointing?
Hold on. Fed policymakers signaled that high borrowing costs help keep aggregate demand in check, limiting the urgency for another rate hike this year.
No, that has nothing to do with bonds.
Yeah. No.
All right.
And then another person mentioned that 4.61 is the highest interest rate with a 2.5 bid to cover ratio.
Okay. So it wasn't a strong option, but that's what the market, so many times I don't look at the numbers. I don't care about the numbers, but I look to see what the market is. And if you look at the yield, you see that the yield is rising. And we know that the short-term traders have been kicking off on the yield. Like I say, I don't read the numbers. I don't listen to that. I can look and see if the market generated information. When I see it sell off like it did, I know it was a questionable auction. Now, yesterday I knew that, and I went to look just to help you. And, Rick Santelli described it as a sloppy auction, which was consistent with what we saw and consistent with the break we saw. Okay. We've got about 9 minutes.
Okay. And I'll share a comment here. I always think about Annie Duke's book, Thinking in Bets. She talks about the danger of resulting. Sometimes we take a profit and then feel terrible because we shouldn't have taken the profit. However, several times taking the profit was the correct decision because that's what the odds favored at that time. Looking back and saying it was wrong just because the market continued in that direction is just resulting.
Yeah, I've always liked the word resulting because it's amazing. And that's so many times people think rather than share with you what was really going on, and they judge you. You may make a great decision. You may make a decision. Let's say the odds are 75% it's going this way, and only 25% it's going the other way. And you get out of the trade on the 25%, on the 75%. The odds were that's the best trade. And guess what? They're only odds. So the one time that doesn't work, it's amazing that the experts come out of the woodwork. Oh, that was dumb. Well, they're just looking at the results, not looking at what the trade or the odds were itself. And playing cards, you may sit there and play cards, and the odds may be in your favor. The example I use so often is, if you're playing 5-card stud and you're given aces back to back on the original deal, guess what? The odds are clearly in your favor, and you clearly have to bet that hand. But there's going to be times somebody is going to draw out on you. They're just odds; they're not absolutes. And I've sat there at the blackjack table in Las Vegas, and somebody takes a hit on 17, and they get a 4, and everybody congratulates them on what a great decision they made. It was an absolutely stupid decision. But unless you're counting cards and that the odds are with you, but very few people can count cards. But then people pat them on the back and they say, boy, that was really good. Well, that's, again, they're looking at the results, not at the process. Because that person more often than not will lose on that trade. Okay? What else we got? Got about 6 minutes.
Okay. I don't see any other questions right now. So do you want to do a few of the slides with regards to homework first, or do you just, what would people rather do? Do you want to wait?
No, we'll just wait. The
Okay.
big thing is to do the homework. Yeah, it's one thing to how do you do the homework, but really, if you really want to be a successful trader, fessing up to do you do your homework every single day religiously is really important. I have worked with an awful lot of traders over the years, and I've known a lot of traders that talk a big deal. I know very limited number of traders that truly do the work every day. We were talking yesterday about some of these professional athletes, and how much work and that they put in. And notorious about Tom Brady. His dad said it could be raining, and he's out in the front yard passing the ball or working out. And the reason he knew that Tom wasn't going to go back into football because it was raining and he wasn't in the yard working out. very few people will go through that routine. They talk about Tiger Woods. He'd win a golf tournament and they're inside the club and they're having, cocktails and stuff. And where is he? He's out on the practice green working on shots he wasn't too happy with. Those are people that really want to win and want to be good at what they do. They work at it continually. I mean, you listen to some of these pros and you start to understand how much they work and how competitive they are. And most people will not put in the time. If you don't put in the time, then it's really difficult to be competitive. Okay? I'm sorry to be so luxury, but that really, I mean, so much of what we're talking about here is just, I like the Nike saying, just do it. It's one thing to plan. It's one thing to have, a nice setup and really organized and all that, which a lot of people equate with doing their homework, but it's the time that they have to put in. Okay, so we got 4 minutes. The tempo has been exceptionally slow going down today. And so after the release, nothing will surprise me. The market is very long, 165 handles, but remember, no backing and filling. And the backing and filling means if it comes up, backs, moves sideways like a stair step, it gives the inventory a time to come to adjustment, get some of the weaker hands out, get stronger hands in, and it goes straight on up. There's nothing, if it starts to fall, it can fall very quickly. There's no support under. There's an awful lot of weak hands, longs in here, and they're counting on the number and everything being good. If they don't get it, watch out. And we're going to hear a lot of the Fed's thinking, and then they're going to relate that to the bond auctions, that are going to relate that to the market overall. So we're getting closer, and you can see we're getting a little bit of short covering. Tempo has been very slow today, been very slow. So, coming into the number, there's a lot of short-term traders that said, doesn't make any sense to be short because they don't know what it's going to be. So you get just a little short covering just ahead of the number. Okay, we got less than 2 minutes, but we got time for any subject you want to talk about.
I know somebody had just typed in, the comment about the 10-year, and I didn't get to it, and I don't want to break your flow, but they said yield spike. Or I don't know if this was a headline or what that they typed in, but it said yield spike after ugly 10-year auction sees biggest tail since April. Dealers
Oh, okay.
stuck holding most paper in a year.
Okay, so it was a bad auction. It was a bad auction. A tail, when they talk about a tail on the auction, that means that if it's a really tight auction, the bids are, really close together and there's not a lot of variance. But when they talk about a tail, that meant in order to fill the auction, they had to take bids that, moved substantially away from what, the best bid would be. It was like a tail on a kite that, they keep taking the bids until they got enough to fill the auction. And the fact that they had to go that far back was a lot. And then the other thing they look about, who ends up holding the auction? With it strong hands that hold after the auction, people are going to, put it away, or is it held by institutions that have to then go find some place to resell it to get out of their inventory? But, that comment was, it was a bad auction. And that's what when you look at the market, that's market generated information is telling you the same thing. Okay, so we're going to get the numbers or the release. It takes a little while, but we'll see what the market's reaction is. Okay, so it's 1 o'clock. Somebody let me know when the release is out. Is it released yet?
Oh, you mean the Fed? Somebody's saying Fed minutes, not number. Nobody has typed in that yet. Somebody said, tell Jim I decided to bid only on 1 billion for my personal account
filled.
rather than 2 billion.
Piker,
Order filled.
okay. So the market didn't, I'm sure it's out. I'm sure people are reading it by now. No cratering. The market, went up a little bit, but no, now they'll watch this for a while. And sometimes it has no effect because sometimes there's nothing different than what they expected. Sometimes there will be comments by some of the Fed members that caught them off guard a little bit and told them they were more, hawkish or, or positive than they had anticipated. Okay, so not a lot. I mean, there was a little short covering. They were right about half back from J period. Didn't do anything. I don't see anything in the bond market. I don't see anything in the 10-year that said, wow, they found new information. I don't see anything in the 2-year. Okay, so it's pretty quiet. The market's got what's one? Market's got what, 2 hours to go? 3 hours to go?
The market's got 2 hours.
Okay.
To the person that gave that headline out about the yield spike after ugly 10-year auction, could you share the source where you got that headline from? A couple of people are asking for the source for that.
My guess is it would have been on CNBC. They're usually pretty quick. I mean, that's what I do. I keep if I don't have a program going on like now, I have CNBC on. I can just click on and go to it and listen to it. And usually you'll have Rick Santario, what's his name? Rick
Santelli?
Santelli will talk about it, and Steve Leisman will talk about it. So, you can get the numbers pretty quickly. That's where I get it, because with TOS, I can have it right live on my machine. Okay. Nothing's happened in here, so let's go to the homework. Let's look at the homework slides.
Okay. Let me see here. 1 second. I will get. Let me take this screen. Okay. Can you see my screen?
I can. Hold on a minute. I want to put up the charts on mine in case I need to go. Okay. Now I'm going back to your screen.
Okay. I'll just to explain for folks that this is their first intensive. So we do this homework workshop, to give you an idea of the top-down approach that Jim takes, with regards to, writing those recap reports and things that he's looking at and including, so that can help you understand what types of things you need to be doing for your own homework. And homework is something that if you are not consistent and doing it religiously or doing it every day, it's something that, a successful trader needs to do. So it brings it to your attention if you're not already doing it. And then also, if you are doing your homework every day, maybe you're just going through and writing down the references and pieces of information to carry forward rather than some other important things, that are critical to understand and to include. So that's why we have this. And then also, to encourage you guys to start doing your homework consistently and get on that part of the journey, because it's just so important to your success. We do have what we call, you'll probably see it, that was on the schedule, that's starting on October 23rd, Monday, we have what we call the voluntary client homework submission and evaluation period for that week. And what that is essentially is If you want, if you've already been doing your homework and you just want us to take a look and evaluate, see how you're doing, you can submit it, and RJ and myself, as time permits, will take a look over it and then give you some feedback. What I will say, the caveat to this is that it's limited to the ES, obviously, because that's what we're using teaching in here for the intensive. And then also, if you are using a lot of other technical analysis things, that's not something that we will be able to comment on, et cetera, since chances are that we don't use it. So keep those things in mind with regards to that. And if you think of any questions with regards to that during the webinar to get clarification on, by all means, type in, let me know. Okay.
Incidentally, before we do this, on my machines, I don't have any technical studies at all. Occasionally, I will have. I may have the volume profile on the right and the traditional profile in front of me. I may occasionally have the 200, 100, 250-day moving average. But there's no other studies on there, just so you know, in there. Okay, now, the first thing, and this is how I do my homework, doesn't mean how you have to do it. But the madness, or the method behind my madness, is that because I'm a short-term trader, at the end of the day, my trading can be pretty short-term in nature. So in order to get myself out of that mindset, the first thing I do when I do the homework is I go to the monthly bars, because that's the longest bar period I use. So I go to the monthly bar, and the word that continually comes to my mind is perspective. So I go to the monthly bar, and I want a perspective of what is really going on in the market. Okay, Jen, let's look at the next slide. So it's top down. You know, it's one of the traps traders fall into, is thinking too small, such as thinking about what is right over the hood. That's just, you know what, and the reason I say, like, I start from the top down, you're so easy to think of what's happening right now, what's the last thing you saw, which is usually the easiest thing to remember. When you observe markets almost exclusively with short-term view, you are not aware of all the situations and possibilities that may be available. Your imagination is diminished rather than expanded. You are much more vulnerable to the possibility of experiencing the always unexpected shock and awe when a market makes a nonlinear move. That doesn't mean you're going to get all of them, because they still happen and surprise you, you know, all the time. But what you're trying to do is prepare yourself the best you can for the unexpected. So again, when I sit there and I go to the top down, that takes my focus, totally changes my mindset from the little things I was looking at the end of the day into my own account to what the bigger picture is. Okay, let's look at the next slide. Begin by reviewing the monthly chart. Long-term trend, is it up, down, balancing, up and balancing, down and balancing? It's perspective. What does the longer term market showing? Are the monthly bars one time framing, or is there more give and take to the market? Or is it net being relatively unchanged? Again, you're trying to get a perspective. Is the market trending, or are there broad trading ranges? Markets go from bull to bear to balance. They seldom go directly from bull to bear. Change usually occurs over a transitioning period. This period is referred to as a bracket or bracketing phase. Jen, let me see what I've got for the next slide. Okay, now I'm going to stop. I'm going to go to my charts for a second. I want to show you what I was just talking about.
Okay, let me know when you want me to give you the screen.
You can give me the screen right now.
Okay. There you go.
Okay, so I'm going up here, and I put in 5 years. Why did that not happen? Oh, there it is. So I put in 5 years. Then I come up and I put in monthly. Okay. So then I look at the market and I say, okay, on a monthly basis, the market is one time framing lower, but now I have an excess low. And recently the market's been moving back up. Again, all it is, it's a bigger perspective of what's going on. Now, I don't think these go back as well, maybe, let's see, hold on. Okay, so this goes back a ways. Now, just to give you an idea, here's, is this the Trump election? I'm not sure if it is or not, but here the market is basically, the trend is up. There's an excess low, one time framing higher for 1, 2, 3, 4, 5 months. So for 5 months, at one time frames higher. When you look at that, that should give you a perspective that the trend is up. That doesn't mean there aren't some counter trends. And we said markets generally, they go directionally, balance, directionally, same direction, directionally, balance, reverse. So this went directionally higher, balance for 4 months. So excess low, one time framing higher, balance for 4 months, breaks out of balance to the upside, 1, 2, 3, basically goes up again until, guess what? Balance again, 1, 2, 3, 4, 5, 6, 7, for 8 months, it moves sideways. Now they're wide ranges, but we said we generally, very seldom does it go from bull to bear. It goes from bull to balance to bear, or bull to balance back to bull. Again, that's just part of the perspective, to give you an idea of what's going on. And we look at the current market, excess low. The market goes up. Well, it tries to come down a little bit. Didn't do much. So it's still kind of trending higher. It tried to break the downside, didn't make it. Really, really struggling in here. Get an upside breakout, and now we're one time framing lower. Again, it just gives me a perspective. Overall, the market usually goes bull, balance, reverse, or bull, balance, continuation. That's kind of what I'm looking at the longer term picture in the market, and see, am I balancing? Am I moving sideways, or am I trending? Very, very relevant. Okay, Jen, let's go back to your slides. We'll switch back and forth here.
Okay. Yeah, screen hockey. 1 second. Okay.
Okay, and we talked about it's written down. Is it up or down? Balancing down, and balancing up. Are they one time framing? Are there broad trading ranges? These are the questions we just went over. This is part of your perspective, and I can't say enough how many times you will get surprised. You will have something else in your mind because your orientation is a little bit longer or a little bit shorter, and all of a sudden, when you do your homework, you get a wake-up call. And so, uh-oh, wait a minute. That's not the way I saw the market. Okay, let's go to slide 4. Next, I go to the weekly. Is the weekly mark trend? I mean, same question. Is the weekly chart trending? Is it showing balance? Are there overlapping bars developing into a bracket or trading range? Are we within a balanced range? Is the weekly bar one time framing? What are the most important weekly references or benchmarks? This includes excess or lack of excess. You're just again trying to get perspective. Jen, we're switching back over to my weeklies.
Okay, 1 second. I'll give you the screen. There you go.
And I come up here and I change to the weekly. Okay, now I look at the weekly, and so I'm seeing here at the market, it's one time framing higher. Then it moves sideways for 1, 2, 3, 4, 5 weeks, a little inside week. See a little inside week, the market's really come into short-term balance. This low right here, a little balance, and then you get an upside breakout. Go with the upside breakout. Okay? Then you see you get you finally get a high. But again, it just gives you a perspective. So you got a downside breakout. Here it moves sideways for 1, 2, 3, 4, 5. And in 6 months it breaks, or the 6 weeks it breaks to the downside. You can overthink this. But again, do this constantly, just the perspective, so I understand what is going on. Okay, Jen, let's go back to your charts unless there's a question. Is there a question before we go on?
I don't see any questions yet.
Okay.
So when we get some, I'll let you know.
Okay, back to you.
Okay.
Okay, so this is what we just talked about from the weekly. Then we go to the next graph, number 5. Okay, next review the daily chart. Determine if there's a short-term trend or balance. Observe for one-time framing. Identify areas of common lows and highs. Observe the previous day's settle relative to the references gathered via the monthly, weekly, and daily bars. See the daily excess or lack of excess when viewed on the daily bar. Remember, gaps are also a form of excess. Too many gaps are a sign of emotional market. I'm just giving some things that go through my mind that I look at. Okay, one more time, we're going back to my chart.
Okay, let me give you the screen back. There you go.
Okay, so now we're back to the daily. It's amazing. You get somebody's talking earlier. Here's the 200-day moving average. You see how this little breakout really gained strength from the 200-day moving average. Now look, so I had this balance. Remember, 2 inside weeks, and then I get this breakout right here on Friday. If you haven't done this homework and you don't have this picture in your mind, it's as price is moving, it's easy to forget you got a breakout, and it's easy just to fade it, go the other way. Having this picture in your mind is very helpful. I hated this, no excess, and I'm prejudiced. Oh my God! But then it's a breakout, and watch out. You got the breakout. When you get the breakout, you're going to get stops. There's going to be stops above this area. Then you say, okay, then it goes, one time frame, one time. Now and then you've got a reference. You can see up here, this is that gap we were talking about. And see, yesterday's high was right at the gap, right? What are the odds it stops right at the gap? Not very good, but that's exactly what it did. So I understand. This is what the market was looking at too. Short-term traders are gunning for it. Now you have a little excess high. You have a little inside, today's a little inside bar in there. So we're at when I used the phrase the other day, we're at a go, no go level. It was some breakout. Now this would be a go, no go level right here. Do you break out to the upside or do you fail? Again, there's no secrets to it. It's just the operative word that I keep coming back with is maintaining perspective. What does us in so many times and where the biases get us are so often when we lose perspective of what is really going on. Jen, let's go back to yours, please.
Okay, before we do that, we do have a question. Somebody's asking, can you go over visual reference of excess, in these timeframes, just to point out? I know this is this person's
Okay.
first intensive.
Here it is, right here. There's excess, right there.
Maybe you
Here's
could zoom in a little bit because it is, smaller, depending on people's screen size and whatnot.
Okay, this is excess right here. This is excess right here. This is excess, little tiny excess. This is excess. No excess down here. Okay, excess is just going to be, went high enough to cut off the selling, or went high enough to cut off the buying, or low enough. Low enough to cut off the selling, or high enough to cut off the buying. It's a good auction. It should move away from it quickly. So here's the excess high. Excess and balance, two most important concepts we deal with. Okay, Jen, let's go back to you.
Okay, 1 second. Okay,
Okay, and then we go to slide 6. Next, review the profiles. The next step is to study the daily profiles. This is now remember, to begin with, we went top down in order to get a bigger perspective of what is going on. When we get to the profiles, here's key. When I get to the profiles, we reverse the process. So remember, when I get done with the end of the day, I'm thinking pretty small. I want to open my mind up. I go to the monthly, the weekly, the daily. But now when I get to the profiles, I want to start thinking about what I may want to do tomorrow. So at that point in time, now I start looking bottoms up. The next step is to study the daily profiles. This is the bottom up part of the preparation. What was the market attempting to do yesterday? How successful was it in fulfilling that attempt? Okay. Yesterday, the market was trying to go higher. How successful was it? Well, wasn't very successful. The volume wasn't very good, and we got no excess on the high, but we couldn't get into the gap. What was yesterday's attempted direction? If the market had a direction, then look at the volume. Okay, we're talking where was value? What is the profile structure? So remember, one of the things we saw in yesterday's profile structure, the B shape. So we had liquidation in the afternoon. It gave us the B shape. The B shape is the structure that represents short covering. If you have a B shape, if you had short liquid, you had not short covering. You had long liquidation, but if you had long liquidation and new money selling, your profile would have been elongated. Yesterday's was not elongated, so all we saw was some longs. Just got a little bit nervous and got out. She had some liquidation, but it wasn't joined by new money selling. Now, if you're only looking at price and you don't understand the importance of structure, you can think, boy, that market's weak. If you look at structure, it will give you a different thought if you read it right. Like yesterday, I'm sitting there saying, well, there's the B formation. We had liquidation, but I don't see any signs of liquidation and new money selling. What was yesterday's attempted direction? If the market had a direction, then you look to see, was New York volume good or bad? Where was value? Profile structure, does anything stand out? We just talked about that. Who was in the control? Did the market react to the references? Yes, it did yesterday. Is there a spike towards the end of the day? No, there wasn't. Remember, a spike's got to be outside of the previous day's range. Now, this isn't all inclusive. This isn't all inclusive by any means. It's just as you're constantly you want to get yourself away from what went on today. You want to open your mind, and you want to kind of start fresh, start with a top down and then a bottoms up, meet in the middle kind of thing. So you get some idea of what is really going on in the market and what you might be looking for on the following day. Okay, let's go to the next slide. Was the overnight inventory this morning? What was the overnight inventory this morning? And was there a correction to the overnight inventory? Let me say, I put this in a time for self-reflection because this is where, you can really help yourself. Did you observe overnight inventory? You want it to get to the point where it's second nature. When you really know things like back in the car of the garage, you just do it by second nature. Was there a correction to overnight inventory? Next, in self-reflection, did you focus on value? Or at the end of the day, somebody asked you said, I don't remember if value was up or down. And you weren't focusing on the right thing. How was tempo? Did anything stand out? Did anything stand out in today's structure? Again, did you go looking for a trade? Did you let the trade come to you? How patient were you? Did you lose emotional control today? Were you able to think in terms of odds and probabilities? What was the message the market was delivering? These are just, there's no real answer to these. These are just questions in if you get to the point, I would print this out or, copy and constantly be thinking about the deeper part of the market, thinking about yourself. Remember, it's market understanding, self-understanding times your strategy. Okay, I'm going to take just a break for a second. Jen, you can put the market up. Have a look at yours. All right, now, remember how slow the tempo was today? Remember the tempo was just grinding, slow all day long? Tempo is one of the most important intangible factors that you're ever going to deal with. People ask me to explain tempo. I can't explain tempo. I can tell you about tempo. You have to learn it from observation. But the tempo going down was just excruciatingly slow all day long. Now we came out and the auction came on the bonds. It wasn't a very good auction. It put a little more pressure on the downside, and we got a little bit lower. You didn't get into yesterday's. You didn't get down to yesterday's opening, and now you get a short covering rally. Again, a lot of times I don't see the short covering rally coming a lot of times. Now, let me think, but I can sit down there and say I don't see it coming, but I know the odds of it happening are decent because of the tempo. And remember, tempo was very slow. Now, next thing, you're looking at the day time frame. If the market got too short, this is what we said earlier. Now, this is in a very small time frame. Sometimes a market has to rally before it can break first, before it can break lower. What is the message? What it's telling you is short-term inventory got too short. You had to correct that short-term inventory, replace those shorts with new shorts before the market could go lower. Sometimes the market has to break before it can rally. So, if it gets too long, sometimes you have to have a liquidating break before the market can get rid of the weak hands and then replace with stronger hands. So if you need to understand the process of short covering and long liquidation so that you don't mistake it. If you're only following price, remember, if you're looking only at price, you're not getting context. As we said, Heraclitus said, no real learning starts without context. They also said that nobody steps in the same river twice. So these things, one of the things that makes trading difficult is we don't have a template we can put over it and say this is going to help. But you're looking today, the market was very, 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 very slow going down. And my guess is all you got today is a lot of short-term traders. They got too short. But once you get a short covering and they start covering, one feeds on the other, the next one covers, etc. What we're looking at right now, it's a little tedious, but I've given you this before. This is what you're looking at right now on your screen, is what it looks like on a screen-based trading, electronic screen. What this same thing looked like on the floor of an exchange, remember you've got a pit on the floor, then you've got the bigger traders stand at the top step, smaller traders down on the lower steps. If the larger trader at the top of the stairs realizes that the majority of short-term traders are short and they've kind of followed each other and they're overwhelmed to the short side, all of a sudden that big trader on the top, keep in mind, if he's standing on the top, if he puts his hands so the palms are facing the crowd, he's selling. If the palms are facing him, he's buying. If the palms are facing the crowd, he's selling. If the palms are facing his face, he's buying. So he realizes, just like this morning, slowly he realizes everybody is short. all of a sudden, he puts his hands, the palms of the hands are towards his face, and he starts to buy. That starts to scramble. These short-term traders start to buy. One buys, another buy, and they feed on themselves. As the crescendo builds, all of a sudden this trader puts the palms of his hands out, and now he sells into them. He got them started, he manipulated them. It's legal. Okay, now that same thing, that's what happened on the floor. I can do that same thing. I can sit out here in Prescott, Arizona. I don't have the money to do it, but I can look and I can sit there and say the tempo is slow and they probably got the market very short. If I wanted to, say I have a little hedge fund, I say, okay, let's have a little fun. So I go in and buy and they get the shorts covered and then they sell into them. Now, I don't know if that's what happened, but it well could have been. That happens all the time. It's fair. I mean, but it's a game. Trading is a game. And there's people that will, they'll take advantage of you. Okay. Any questions on what I just talked about before we go and finish this up?
Yes. Somebody's asking, who would be the top step trader today in screen-based trading? I was able to use that image this morning watching electronic activity before the PPI number came out.
Who knows? Look at how many people are out in the world. It's just somebody with money, or maybe a couple guys get together that they can do it. I mean, you don't know who it is. They don't reveal that. And sometimes maybe 3 or 4 figure it out and work together. I don't know. Okay, what else we got?
Somebody's asking, when the market's confidence is low, like today, is it fair to avoid holding trades for too long?
Oh, yeah. I'd be very careful on a low confidence day. You're just asking for trouble. Don't overstay your welcome. When confidence is high, you want to stay around. Confidence is low. No, somebody said that, they didn't keep a trade long enough. And I said, I'm not sure that was wrong today because the confidence was so low. I'm not sure that was the incorrect decision. On another day, it might have been, a trend day, and it's really moving with good volume and confidence. Different circumstances. Okay, what else?
I think we can go back to the slides.
Okay, please. This is, if you will go through this self-reflection, you will do yourself a tremendous amount of good. This will just, this is the best roadmap we've ever had for what are the things you need to really work on and think about as a trader. And there's others, but this was really very, very helpful. Okay, let's go to 8. Remember to include the following concepts in your analysis: balance and excess.
Concepts, not concepts.
Concepts: excess and balance, value, exponential data points. Now, exponential data points, if there's one poor high, maybe that's a +5, meaning, good chances takes down. 2 poor highs, maybe it's a +25. It's exponential. It's not one to the other. It's a multiplier effect. Now, when I look at the current lows down there, no excess on the low, 4 days, to me, that's high odds we're going back down there. I don't know when, but I'm carrying that forward, that information forward. You're looking for evidence who was in control, okay? If it's a rotational day like today, probably no longer term. It's probably all short-term traders. You get a trend day, you got new higher value, lower value. It's probably, a little bit, at least some semblance of a little more serious longer-term traders. And then you're asking yourself, are there pieces of information to carry forward? For example, I'm carrying forward the non-excess low from last Friday in those 4 days. The key to carrying information forward, where it messes people up, they think they have to use it immediately. As I say, it's like putting it in a little matchbox, putting a rubber band around it, setting it aside. So like that low on the bottom down there from last Friday, all of a sudden the market starts to really give way to the downside. Pull out the little box and see, what do you have for information you're carrying forward? And that would bring it front and center. The gap from yesterday, as the market starts up yesterday, pull out, if you're carrying forward that gap, pull out the little box, okay? And the gap turned out to be a great reference. Was it relevant 2 days before? No, but it really became relevant yesterday. Who's in control? Always asking, like today, come on, you're inside yesterday's range. Pretty certain it's all short-term momentum traders. Okay, let's look at 9. Pre-opening. So prior to the opening, you review the overnight inventory. We've already talked about the odds of overnight inventory correction are high if inventory is overly long or short. About 70% of the time, there will be a counter auction. If there's not, that's usually a sign that the market will go with the imbalance. Is there a double distribution or multiple distributions in the overnight? If there is a double distribution, I do reference the double distribution. Double distribution is a sign of change, whether it's overnight or during the day. If there's a prominent point of control overnight, the more prominent the point of control, meaning the wider it is from left to right, the greater the odds that it will be revisited. Nothing's 100%. Did the early morning pre-market trade form visible references? From visible references, make the inventory weaker. Did the early morning, I'm not sure, trade from, did the early morning pre-market trade from visible references? If it did, it generally makes the inventory weaker. It's just, if the market, if there's buying, it's better if it comes from someplace that doesn't stick out as being, really identifiable. But let's say it came from exactly half back. Well, question it a little bit more. Is the market opening in or out of balance? As we saw today, the market opened within yesterday's range. Opening within yesterday's range increases the odds that we're going to have a rotational day, increases the odds that the early morning going to be chopped. You saw that work today. Is the market opening in or out of balance? We opened in balance. Are there gap guidelines? There were no gaps or spikes in play. Again, this is just another pre-checklist you can use just to help you get mentally prepared for the day as it opens. The worst thing is all of a sudden, I'll be with you in a minute. I got to grab my coffee. Okay, got the kids go. The market's open. Let's go. Your chances of success are pretty limited. You need to really settle your mind. You need to do your preparation, your workout, so to speak. So when the market opens, you are mentally calm, mentally prepared, but mentally calm in order to assess what you think is going on in the market. We're not always going to be right, but the first thing you're going to do is the confidence high or low. Are we in or out of balance? There's an awful lot of things you form the habit to do day after day after day. And it was amazing. It will lower your blood pressure. It will lower your anxiety, and you will be able to make calmer decisions in the market. You won't be so erratic, and you won't get trapped by, a lot of noise in the market. Okay, let's look at the last slide. I think there's 10, right?
Yeah, that's just this. So
Oh, okay.
that was the last slide.
This is stuff. Go over this, make your notes, think about, work out your own routine. But this is so important for a good start in the day. There's nothing worse than all of a sudden you haven't done your homework, you race in the morning, you're taking the kids to school, and all of a sudden, what am I going to do? What's the market doing? It's very hard to get mentally prepared to trade, and this is a very competitive business. Final questions?
Yes, here's a question. I currently do my preparation all in one go, 30 minutes after the open rather than at the end of the previous day. What do you think about that?
I don't like it, but that's, again, what I say so often. If what you are doing works for you, be my guest. If what you're doing doesn't work for you, then you need to reevaluate what you're doing. Every one of us is different. Every one of us is different. We trade differently. It's got to be what works for you. I don't like it because I like to have all my stuff done and be mentally prepared. So I'm better off to handle some unexpected things, and it's not uncommon to have unexpected things in the morning. Okay, what else?
Okay. How much of the homework answers not sure what they're asking here. How much of the homework answers recommended go to your, I think they mean go to your journal. Is it valuable to put them all in?
I don't put any of them in the journal. I don't, I just like to keep them in, I just like to get the whole total package so I'm pretty well oriented, so that I'm capable of making adjustments. No, I do nothing. I don't put the journal, I don't put any of them in the journal in the morning. Okay?
Okay. I think that's all the questions I see for now. I don't see any other questions right now.
Okay, so I'm just looking at fast look at the market.
Okay.
We're-
1 second now. There you go.
So we're
Another
right-
question.
We're right about half back. Notice the K, I think, is that K period? Is it?
Yes,
half
we're
back?
currently in K period.
It's half back. It's half back and it's also the settle. So it's short-term buying from a very, very weak level. But again, waiting for tomorrow, it's an inside day. The market's come into short-term balance ahead of CPI. Okay? Anything
Okay,
else?
and yeah, one more question here. What other non-TPO information does Jim consider during for his morning preparation, like news or anything?
Oh, yes, yeah. I want to know what time major news announcements are coming. I don't want,
Not
once they
the
come out,
numbers, mind you, or anything like that, but the time that the news is supposed to come out.
yeah, so I'm not shocked. And then I want to be prepared to react to the market. I don't want to hear the news. I don't want to read the news. I want to react to the market generated information. Were they buying it or selling it? Because a lot of times when it comes out, you don't know. You may know what you read, but you don't know what the whisper number is on the street among the real professionals. I talked to the individual that was runs one of the major banks, the trading desk. It was a client, and we were talking last week about whisper numbers as the job report came out, and it wasn't anything published, anything. It's just kind of among the professionals someplace. I never like to know the whisper number because it sometimes it would cause me to lose my objectivity. But big thing is I like to be prepared as much as I can and understand that the number, I want to know what the market does with the number, because the reaction may be because it would be close to the whisper number or something else, which I don't care about. I don't care if it was the expectation below or above. I want to know what the market, people with real money to buy and sell, I want to know what they do and what they think of the market. That's the most honest answer I'm going to get. Okay?
Okay, and the person that had asked about, doing their preparation, they just wanted to clarify and say they do it 30 minutes before the open, not after. That would be crazy. Yeah.
I'm sorry. I'm going, huh? No, actually, I don't have any problem with it. It keeps it fresh. I do like to, that's what I do. I like to do it as soon as the market closes at the end of the day, is I go and do my first look, and then I update it, prior to the opening. I like to do it when it's fresh in my mind at the end of the day, but I also like the fact that it takes me immediately from this really tiny thinking of short-term trader to a larger perspective in there. So no, I have no problem with what you do. Okay.
Okay.
I was biting my tongue when you said 30 minutes after the opening, or Jen read it that
Yeah.
way. I'm like, good luck.
Sorry, I might have I might have misspoken. Okay, somebody made the comment. The J period high is at the overnight half back. So here's the overnight half back. It's exactly there.
Okay,
Any comments
yep.
about that?
No, a week. All we've got in here today is short-term traders. They're trading from mechanical levels. The high is mechanical, the low is mechanical. I mean, it's just, this is what the big boys aren't in here. This is short-term traders, as we would say on the floor, picking each other's pockets. Okay? But observing that is very important. You want to get to the point where you observe that. Now, when you observe the K period pullback high and the J period, or the K period pullback low and the J period high, all of a sudden you see it gives you, to both ends, but that gives you a pretty good idea. It's all short-term traders, nothing major going on. Okay.
Okay, and then one last question here. Is the lack of a major more at news like FOMC reflect acceptance of current price levels? Major move. Is the lack of a major move of news like the FOMC reflect acceptance of current price levels?
No, I don't think so. I think there was nothing unexpected. There was nothing unexpected in there. The market's brought itself into short-term balance ahead of tomorrow morning. And I'm not betting on the upside or the downside. I don't like the upside. I don't like the downside. Okay. Thank you much. And we will be with you in the morning. We're early tomorrow morning, right? So we're
Yes,
here.
set your alarms extra early, especially you, Jim. We're
We'll be here when they announce CPI, and we'll be able to,
right.
make some
8:15
assessment.
a.m. Eastern is when tomorrow morning's webinar starts.
That's
Okay.
5:15 my time. I better go to bed. Good night. See you guys.
Okay.
Bye now.
Okay. Have a great rest of your day, everybody, and we'll see you early tomorrow morning. Thank you so much. Bye-bye.